So the next thing we're going to talk about is called stock splits. A stock split is when a stock actually splits either in half or quarters or by five. So a stock split is a way for me to get more stock available, but I reduce the price, and we'll talk about that. The whole thing is I'm able to actually now get more shares because remember, I'm only authorized so many shares, but by splitting my stock, it allows me to increase my number of shares. But at the same time, it reduces my par value. So here I have this company, Roject, has 10,000 shares of $100 par common stock. Currently, the market price is $150. That's what it sells for. So I'm going to do a 5-for-1 split. So here's what happens. My 10,000 shares will be multiplied by 5. So I'll now have 50,000 shares. But my par value of 100 will be divided by 5 to make the par value $20. So a stock split, here's what happens before the split. My equity is still $1 million. Either way, a split doesn't change anything except the number of shares. So here's before the split, here's after the split. Now I have 50,000 shares, but my par value was also reduced. So this was a 5-for-1 split. If it was, let me back up to this slide. If it was a 4-for-1 split, I would take the number of shares times 4 and take the par value and divide it by 4. If it was a 3-for-1, I would change this number to 3 or 2-for-1. So whatever the number of split is, you're going to change that. Okay, so here's an example of what happens before and after. And here's the most important part of this. Stock splits do not require a journal entry because nothing has changed. So you need to remember that when you're going to issue a dividend, you're going to issue dividends to stocks outstanding. But if you had a stock split, then you now have more shares of stock. So you always need to keep a running total. By the way, guys, this is really important. Always keep a running total of the number of shares outstanding when you're doing the homework, especially. Okay, I want to talk about one more thing. This is called Treasury Stock. Now, Treasury Stock has nothing to do with the government, but what it is, it's when I buy back my own stock. It's called buyback. And I'm going to buy back stock for a couple reasons. They call it reacquire in this textbook. But I may want to turn around and resell it to my employees. I may want to give it to bonuses, or I may actually want to sell it back on the stock market at a higher price. So Treasury stock is a form of an equity account. However, it is the opposite. It takes away from the equity. So it's common stock minus any treasury stock. Kind of like the accumulated depreciation subtracts from the equipment value. Treasury stock will subtract from the stock value on the equity sheet. Okay? And I also have something called paid in capital from sale of treasury stock. So before we get started, and don't read all this down here yet. What I want to talk about, here's where I stand right now. I have common stock, $25 par, 20,000 shares authorized and sold. So my value in my common stock account is 500,000. That represents this number of shares times the par. In my paid in capital in excess of par, I have 150,000. So here's what you need to remember. Write this down, please. In the treasury stock, the normal balance should really be debit because it's opposite of the equity account. The normal balance is debit when I buy the stock, and if I turn around and sell it, I'm going to credit the treasury stock. So normal balance is debit for treasury stock. When I sell the stock, I credit it. Here's something else. You need to write this down. Just how only the par value times the number of shares goes in and out of the common stock. The same thing here. Only the actual amount paid for the treasury stock, only the amount I actually pay for this goes in and out the treasury stock account. Everything in excess or under goes into my paid in capital. So let's look at an example. Hope I'm not talking too fast. So on February 13th, I buy 1,000 shares of my own stock at $45 a share. Remember, when I'm buying it, I'm spending money. Then I'm going to turn around and sell 600 shares for $60. Then I'm getting money. And then I'm going to sell the other 400 for $40. Well, I paid $45. So here are the 3 journal entries. Here's my journal entry number 1. This is when I buy back Treasury stock. So I'm spending $45,000 cash, and I'm going to get a $45,000 debit to Treasury stock, which represents 1,000 shares at $45. So no matter what, my Treasury stock account has to represent the price it was paid for, $45. So now I turn around and sell 600 shares at $60. So I'm going to get 36,000 cash. That's 600 shares times $60. That's the money I get. But the Treasury stock has to be credited for only 600 shares times the 45, because I go in and out of Treasury stock with the price paid for it. The other $15, which is the difference between the 45 I paid and the 60 I sold it at, times 600 shares goes into paid in capital from sale of Treasury stock. Okay? I know this is complicated. So I sold it for more than I paid. It goes in as a credit. Okay? Now, I sell 400 shares for less than what I paid. So I'm going to get 400 shares times $40. I'm going to get $16,000, which I get my cash. My Treasury stock has to be credited for 400 shares times the $45. That's why it's credited for $18,000. So the deficit is $5, because remember I paid $45, now I'm selling it for $40. So I have a $5 deficit times 400 shares goes in as a debit. So remember which side the money goes into on the paid in capital. If it's more than what I paid, it's credit. If it's less than what I paid, it's debit. So just keep that in mind. That's what this slide talks about. Okay, I can have a debit balance or a credit balance. It doesn't make a difference. So that concludes my chapter 12. There may be a few more things in there, but words of wisdom when doing the homework: always keep track of the running number of shares in each account so that when you get ready to pay dividends, you'll understand how to calculate dividends. Good luck.